Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us for this segment, we have Mark Marex, senior specialist with index research and development at Nasdaq Investment Intelligence, to discuss an index designed to outperform during a rising interest rate environment in the U.S. and a product that investors can own that tracks the index. Mark, it's great to see you. Welcome back to Trade Talks.
Great to be back, Jill. Thanks for having me.
All right. Clearly, there's a lot of interest in this particular index. We all want to be able to make some money while we know interest rates are going up. Tell us more about the index.
Sure. So, I mean, the beauty of this index is its simplicity in a way. It was launched back in 2017 with a pretty long back test going back to about 2004. And the central kind of premise around this is if you look at weekly correlations, right? Returns of stocks and sectors in the US in the large cap space versus the US 10-year Treasury yield. If you look at that on a trailing 3-year basis, you can find some pretty nice differentiation in terms of how sensitive certain sectors are to those yields rising or falling, as well as within sector. Right? How sensitive certain companies within a sector like energy, like financials, are to something like the 10-year yield rising. So what I'm showing here, this is kind of a high-level overview of the structure of the index. You've got a little over 2/3 of the index is outside of the top 10. There's 50 securities in total in here. The top 10 make about a little under a third of the index weight, so not highly concentrated. You're looking for basically the top 5 out of 11 sectors per ICB in terms of the strength of that correlation to Treasury yields. It's a little bit dynamic because we're always updating this on a quarterly basis, but always looking on that trailing 3-year window and picking the top 5 sectors essentially each quarter. Within sector, you pick the top 10 securities, the top 10 companies in terms of their correlations, and you equal weight it. So it's kind of a modified equal weighted approach where, you know, the strongest sector in terms of correlation gets the biggest allocation, and then you get a little bit lower progressively as you move from number 1 to number 5. You can see on this list of top 10 companies in the index, it's all financials and energy, right? Not a surprise. Energy has been doing really well in terms of, you know, the reopening trade, the cyclicals trade, and, you know, the inflation trade. Financials have been doing well because of the rising rate trade, and also kind of similar themes around cyclicality and reopening. So that's why, you know, from at least a top 10 perspective, that those top 2 sectors are energy and financials here, at least for the time being.
All right. And Mark, if we go to the next slide here, we can see that a majority of it is large cap stocks, which makes sense because we know the smaller cap names certainly do have more of that interest rate sensitivity.
Yeah, sure. I mean, I wasn't around when this index was developed. By the way, we developed this with ProShares, which has an ETF that tracks the index. The ticker is EQRR. This is purely a large cap index. I think maybe there are ways to also design a product like this for the small cap or the mid cap space. But our starting point with this index is the Nasdaq US 500 large cap. So basically, you know, Nasdaq's version of something like the S&P 500, looking at the 500 largest companies in the US. What I'm showing there all the way on the right is the breakdown of that size segment within large cap, right? So what you would consider mega caps, maybe 100 billion plus a market cap. You've got 5 companies in there, 13.5% of the index weight, not dominated by the biggest companies, right? Not like some other indexes that are market cap weighted, where you expect to see the majority of the index weight going to the biggest. Here you've actually got, you know, that $10 to $50 billion segment within large cap, well over 2/3 of the index weight going there. And then on the left, you can see that sector breakdown more visually, right? This is not right at the index rebalance and reconstitution date. We're kind of intra-quarter here in mid-February. So these percentages aren't exact, but you can see that they're very close to those kind of target sector percentages where the top sector gets 30% of the index weight, number 2 gets 25%, down to 20, 15, and 10% each. You know, as I mentioned before, you've got energy and financial sitting way at the top here, not just because they started out strong, but they've also been performing strong, at least year to date. And that brings us to our last slide.
Right. And finally, let's talk about that in the last slide that we have here to see where these drivers are coming from and how it is performing.
Yeah, so what I'm showing here on the left is with sounds like a maybe arbitrary starting date, October 28th, 2020, not arbitrary at all, in my opinion. This was exactly when the first COVID vaccine news was announced and 1 week before the US election. This was really the beginning of the pro-cyclical reopening trade and the rising rates trade. It was before inflation really hit. But it was when investors generally expected, okay, we're going to have a robust economic recovery with reopening, and rates started ticking up in fixed income. So if you look at this, the purple line, that's NQERR, pretty much a straight line up for the first few months of that trade. It's still been doing well. It set a high recently late last year and is still sitting at about 85% up since that reopening trade got started. You can see the other products that I've highlighted here. SPX is the S&P 500, NDX is the Nasdaq 100, RLV is the Russell 1000 Value, and RTY is the Russell Small Cap Index. All of them really quite substantially underperforming this one. So whether you were thinking about, tech outperforming or small caps or value outperforming, none of them's really approached what this index has done because it so specifically targets those stocks and sectors that have that strong positive correlation with treasury yields moving up. On the right, you can see how that looks in terms of year-over-year performance for those top 10 names I talked about earlier. Pretty much in every case here, almost every case, these names that are the top 10 holdings right now, they had pretty weak 2020s in terms of price performance when the economy was shut down. Rates were really low and the outlook was very, very kind of anti-cyclical. 2021, a complete reversal, right? In a lot of that underperformance being made up and then some, especially with some of these banks and energy companies.
All right, Mark, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.